Good morning, everyone. I am Siju. Today, I am going to present a very important topic in financial management. The topic is capital budgeting. Capital budgeting is the process of planning and evaluating long-term investment. These are investment whose benefit are expected for last for more than 1 year. Capital budgeting refers to the decision-making process used to evaluate and select long-term investment projects based on their expected profitability and risk. Objectives of the capital budgeting to maximize shareholders' wealth, to ensure owners get higher return, to use resource efficiently, it avoid wastage of fund, to evaluate different investment options, to reduce risk and uncertainty, to plan long-term financial growth. Then components of capital budgeting. There are five main components. First one is initial investment. This is the total cost required to start a project, including machinery installation and a working capital labor cost. Second one is cash flow. These are expected inflow and the outflow of money over time. Positive cash flow means profit. Then discount rate. This is the rate used to calculate the present value of future cash flow. It reflects risk and cost of capital. Fourth one is project life. This is the time period during which the project will generate income. Then last one is terminal value. Terminal value is the project end, like a resale value of machinery or salvage value or scrap value. Then types of capital budgeting decision. There are different type of decision in capital budgeting. First one is expansion project, increasing production or entering new market in the organization. Second one is replacement project. Replacement project means replacing old machines with new ones. Uh, New innovations and new technologies are adopted, and old technologies replacing to new technologies. Then third one is no product project. Introducing new goods or services, new technologies, new machines, etc. New innovations are implementing in new production project type. Then mutually exclusive. Choosing one project among many options. Choosing the best alternative project option can selecting in the mutually exclusive project type. Then last one is independent projects. Projects that do not affect each other. The project was independent. Then capital budgeting techniques. Capital budgeting techniques are broadly classified into two types. One is traditional methods and another one is modern methods. Traditional methods is also known as non-discounted method. Payback period is the mm, one of the traditional method techniques in capital budgeting. Payback period measure how long it takes to recover the initial investments. Then second one is accounting rate of return. This method uses accounting profit to evaluate the project, mainly focus on the profit evaluation. Then modern methods or discounted method. First one is net present value. Net present value calculate difference between present value of inflow and outflow. Then internal rate of return. This is the rate at which a net present value become always zero. Internal rate of return is higher than the cost of capital the project was as accepted. And last one is profitability index. This show the ratio of benefit of cost, the profitability of the organization, the profitability of the investment. Then capital budgeting process. Uh, First stage of capital budgeting process is identifying opportunity. It means to finding the possible investment project, possible investment ideas, opportunities, etc. Then screening. After the opportunity can be identified, then the many opportunities can identify. So the opportunities are in the screening process and the screening and they reject the some proposal, etc. Then evaluation. After screening, analyzing using method to like NPV and IRR, EI, etc. methods are usually analyzing the budgeting process. Then selection, choosing the best and uh, choosing the best project. Then implementation. After choosing the best project, then the project was put into an action. Then last one is monitoring and a proper review. Comparing actual performance with expected result. Then importance of capital budgeting. Capital budgeting helps in long-term planning. It improves decision making. It reduces financial risk. It ensures efficient use of fund. It supports business growth. Such limitations are there. It is difficult to predict future cash flow. And capital budgeting is a time-consuming process. It requires detailed data analysis. It involves and uncertainty. So I concluding my seminar, the capital budgeting is a very important tool for business. It helps to companies invest wisely by analyzing costs, returns, and risk. Capital budgeting is a crucial role in financial management. So thank you, sir. Thank you, everyone.